Retail's in focus as well. Investors are working through the tariff impacts and also new numbers this morning out of Target and Best Buy. Consumer discretionary, one of just two sectors now in the red on the year. Here to break it all down, Michael Baker, D.A. Davidson analyst. It's good to have you, Michael. Clearly, tariffs are front and center, and that's got to be part of the selling today. But what about what you gleaned on the consumer from both Best Buy and Target?
Yeah, and I'm here at the Target meeting today, and what we're hearing today is very similar to what we heard from a couple of retailers last week, which is really strong fourth quarter. January, okay, but February has seen a big step down, and that's a function in some ways of waning consumer confidence because of tariffs. Also, the weather wasn't great, and February isn't a big month anyway. There's not a lot of call to action, but really that's what we're seeing here is a combination of a weaker February and the tariff uncertainty.
I guess one thing that Target and Best Buy share in common is consumer discretionary exposure and exposure to categories that have been weak, like home, for instance. I mean, Fidelity did tell me that they were seeing better results in apparel, which had also been weak, and in hard lines, which is also part of consumer discretionary. But are these two unique in that sense compared to the rest of retail for what the consumer is going through right now?
Well, it's the idea that discretionary categories might get hit more in a tariff environment. Both Best Buy and Target told us they're going to pass pricing through, but that will probably or could definitely hurt units, and that's the issue. That's what Best Buy said this morning, is that tariffs could hurt them by at least 1% on the top line because they will raise prices, but they expect at least a bigger offset in terms of units. So the discretionary categories, again, Target and Best Buy aren't alone in that sense, but they do have higher exposure than, let's say, Walmart to discretionary categories. Those are the ones that presumably get hit a little bit more.
Can any of these companies buy more stuff in the U.S. to avoid more tariffs, or is that just not possible in these categories?
Well, it's buying in countries other than China, Mexico, and Canada, and that's been a trend that's been happening. But to move outside of those countries and to move more in the U.S., that takes a long time. I think that's generally the idea over time, but that can't be done this quarter or this year.
Do they have any alternative but to raise prices on consumers? And what does that look like in this kind of environment?
Well, the alternatives are to push back on your vendors as best you can, and the bigger you are as a retailer, the bigger pencil you push, the easier that is. See Walmart, we think they'll be successful at that. The second alternative is to eat some of the margin, and I think that's the concern, and that's what you're seeing in the stock today. And the third alternative is to pass it through, and that's where you could see a little bit of a hit on units. So that's the other issue, particularly for discretionary retailers. Again, the non-discretionary type retailers, the warehouse clubs as an example, Walmart should have an easier time not seeing that unit degradation because they're selling needs rather than wants.
Really quick, because you are at the Target meeting, I know they're laying out all sorts of long-term initiatives and flashy new partnerships. They just did one with Authentic Brands as champion, for instance. They're going to open new stores. They're going to lean heavily on digital, which performed well in Q4. Is there anything you're hearing that makes you a buyer on the weakness today and what we've seen from Target lately?
Yeah, well, sure. That story is all very positive. And let's remember, 2024 was a difficult year, but they ended up making their full-year guidance towards the low end of the comp. But they were in line with what they said a year ago. They had a really good holiday season. It's been volatile in terms of the quarters, but things are going reasonably well, with the exception of February and now the uncertainty of the tariffs. But longer term, yeah, we think they're well positioned, particularly where the stock is now. I mean, it's going to be trading at a pretty significant discount to the long-term historical average.
Okay, Michael, thank you for jumping on. Newsy day for us here. Michael Baker, D.A. Davidson. As we look at the Dow now, down more than 700 points, Carl.